Many of us have been working from home since the COVID lockdown started. Many Canadians may end up working from home permanently. So what tax breaks can I get? What home office expenses can I deduct? Ian Martin is back. He'll answer those questions, and then I'll get him to explain why he spent many years working at CRA with not long working hours and a great pension, but then quit to come work here as a licensed insolvency trustee. The Inside Scoop starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ian, welcome back. So according to my cue card here, you were on show 271. That was a year ago. We talked about TFSAs, RRSPs, and debt. That's been a quite popular show. And then, of course, your favorite and mine was good old show 148, which a show that will live in infamy. That was in July of 2017, so over 3 years ago. 10 tips for dealing with CRA and tax debts. And again, a lot of people have downloaded that show. I will put links in the show notes to both of those shows. And what do you remember about that particular show 3 years ago?
Well, it was funny that somehow we joked about this, but we showed up the same day with our matchy Costco $15 shirts.
Exactly right.
And more than one of our colleagues pointed it out and called it a uniform, I think it was, that somebody called it.
Yep, they were wonderful short sleeve shirts, and we had literally, both been to Costco and paid the $15 for them. So those of you watching on YouTube, hopefully we've been able to put up a clip of that because
we thought it was funny. I don't know if anybody else found it funny.
Nobody else was amused in the least at what we wore. But there we go. So today I deliberately did not wear a shirt I bought at Costco. Now, let's get to the key point here. Everyone is asking the same question. And that is, hey, now that I work from home, because I've been working from home since the middle of March when I got redeployed at home, what can I deduct? I assume I can write off my house and everything else, and it's going to be fantastic. So question number one for you, we're in 2020. What rules have changed this year as a result of the pandemic? I'm talking tax rules. What rules have changed this year as compared to last year?
Right. And you're right. It is a very common question. But at this point, there's been literally no change in the actual rules. The rules are very complicated. They're very confusing, even for the experts. And I think it's important that we really emphasize the group of people that we're talking about here today, Doug. We are not talking about self-employed individuals. That would be somebody who has his or her own business. Maybe they work as a contractor or subcontractor. There's a separate set of rules that apply to that kind of person that tend to be a little bit more open-ended, with kind of the general theme of, as long as you incur that expense to make money from your business, it's a deductible expense. With an employee, again, an employee is more relevant to what we're talking about. So this is the person who, up until March, with the pandemic, they showed up to work, they worked their 9 to 5 or whatever, Monday to Friday, and they went home. They literally never worked from home. So that's the change. So those are the people who are going to be asking this question for the first time. So for that person, it's really restrictive. Like, an employee in that situation is, in general, not expected to supply the resources to make money for the business, right? That person supplies their time, their labor. They're paid a salary or an hourly wage for their labor, but in general, they're not expected to be making capital expenses.
So let's think about this. So a self-employed person, can you give me an example of a typical self-employed person who has used their home for the last 20 years? What kind of person are we talking about? A salesperson, for example, who's on the road?
Yeah, it could be any number of things, but quite often with salespeople, salespeople are kind of an anomaly where there's quite often salespeople who are employees who receive a T4 at the end of the year, but they're given special allowances within these rules to deduct expenses because they are on the road more. They have to maintain a home office. If you had, it doesn't fit your business, but if you had salespeople who were out and about all over the province or the country, you wouldn't want to be paying for space here, because it wouldn't make sense. They would never be here. So that person, they're on the go, they're in hotels a lot. So they're given a lot more flexibility, even though they're an employee, to deduct certain expenses. But the person who just shows up at the office and sits at their computer desk, sits at their cubicle and does their job, it's very, very restrictive in terms of what that person can deduct.
So if I'm hearing you correctly, there's really kind of three categories. There's a self-employed person. So let's say I am a plumber.
Sure.
I work for myself. People call me up. I go fix their stuff. I've got a home office where I do all my billing and everything.
Oh, yeah, right. So that would be a good example.
And that hasn't changed whatever you were allowed to do 5 years ago, last year,
Right.
you're allowed to do that this year. And again, I think if you want to know what you can do, well, talk to your accountant. You've been having an accountant file your taxes. You kind of hit the nail on the head. You are allowed to deduct expenses that are used to earn income.
Right.
So if I'm a plumber and if I have to buy a plumbing tool, what do you call that, a wrench or
I was
something?
going to say, you sound like you really know these things well, Doug.
I'm
a
like
plumbing tool.
I'm dialed in here. This is why you watch this show, people. You're getting inside insights. So if I have to do something like that, then okay, obviously that's deductible. And if I have an office at my house because all my clients come to meet with me before we design what the plumbing stuff is going to be, then okay. That's a self-employed person. I'm not getting a T4.
Correct.
Because I'm self-employed.
Yeah, that's a big distinction, self-employed versus employee.
If you get a T4, you're not self-employed. You're an employee. That's what a T4 is. The middle category would be somebody like a salesman or perhaps a long-distance truck driver where there are special rules that say, okay, because you're a truck driver on the road, you're gone for a week, you're outside of your municipality, there are some special rules there.
But people like that, there's a long history of that kind of stuff, and the tax law and the interpretation of it has been built up over many, many years. So nothing really unique this year.
Same as what it was.
Yeah.
So what we're talking about is that third category, the person who works in that office building, that big office tower. They come in, as you say, they sit in front of their computer, they do their work, but now they've been redeployed from home.
Right, very unique because of 2020.
Because of 2020. And probably when the pandemic is over, they go back to the office, maybe.
Perhaps.
So I'm sitting here thinking, okay, wait a minute. I'm working from home. Why don't I get to deduct my rent or my mortgage payment or my hydro or anything like that? Why not?
And the answer is maybe you can, at least some of those things. But it's important to understand the rules. So this is where, I mean, even for nerds like us, we can get confused by this kind of stuff. So there's a form called a T2200.
T2200.
Correct. So I mean, all these things from the government, usually they start with a T. So the T2200.
Why is that?
I wish I knew.
I guess it's taxes, or
maybe
maybe
if I was going to guess, that's what I would say.
maybe Tom invented them. I don't
feel like
know.
I've let you down by not knowing.
I know. So everyone's going to tweet us on Twitter telling us, "Come on, you guys! It's obviously for taxes." So T2200,
right,
which is a form that's filled out by your employer,
correct,
that tells CRA which aspects of your job are mandatory work from away from the office, and for which you incur expenses that are not reimbursed by the employee.
It can be something where you receive a partial reimbursement. So it's very, very detailed. It's called the Declaration of Conditions of Employment. So it doesn't specify the amount that the employee incurs, but like you said, it says, well, here's the kinds of things that Mary or Steve or Joe that they're required to as a condition of their employment to incur, and it has home office stuff, automobile stuff. It can be it doesn't have a lot of categories, but it has a handful of different things.
So maybe I'm a service rep and I go from business to business to business, so I have to have a car.
Yep.
My employer would say, look, I tell you what, you pay for the car, you pay for everything, we're going to pay you, but you cover those expenses. That would be an unusual circumstance, I would think, but okay, maybe that's the situation. Is that a common example, or am I giving an example that's not common?
I mean, I don't think I see that as much with the automobile expenses, because most employers will pay like a kilometer allowance, like a certain rate per kilometer, but then even there will be some companies that don't do that. They leave it on the employee to do that, but it would be kind of considered like a bit of a perk to have that.
Right.
But even if I think we're maybe getting a little bit off track, but you ask the question, so I'll answer it, Doug. So
we'll edit it out later. That's fine.
So if a company though, if they pay like a kilometer allowance that is really, really low, I can elect to, as the employee, I can elect to pay tax on the allowance that I receive, but then deduct my expenses. I would only do that if I believe my employer is paying me like a really, really low allowance and it's to my benefit to deduct my actual expenses.
Gotcha. So again, these and everything we're just talking about there hasn't changed. That's the way it is. So let's pull this back to, you're right, I'm getting off track here. So let's bring it back. So explain to me, what is the 50% rule? And I think this has to do with the old T4044 guide.
Oh, yeah, you're right. So there's the T2200 we talked about, and then you fill out a schedule called the T777. That's the employee fills that out when they do the taxes to say, here's my actual expenses to come up with a deduction. And if you want to try to understand that, you read the guide called the T4044. 4044. Yeah,
4044.
3 4s and a 0 in there. Okay.
Yep.
So, and it lays out, it's supposed to provide some interpretation, some guidelines to understand the minutia of the tax rules. So there's different conditions that you have to meet to even consider yourself eligible for these different kinds of expenses. So before we even get to the 50% rule, so there's two conditions you have to meet where the 50% is part of one of the conditions. So already that sounds pretty confusing. Right?
I'm confused, yeah.
Right. So the first condition is that it has to be part of your contract of employment that your employer requires you to work from home and incur expenses. Well, again, our target audience today, the people that were working in the office until March of this year, do they have they might not even have a written contract. Even if they do, does it say that Joe is required to maintain a home office? Probably not, right?
Because he was working in the office.
Right. So right there, you're going to have people that potentially are offside on these rules. So hopefully the CRA displays some common sense and doesn't hammer people on that requirement because it's such an extraordinary circumstance.
Hopefully the CRA displays some common sense.
Famous last words.
We're going to come back to that comment.
Right.
Keep going.
All right. So assuming that condition is not a deal breaker, you have to meet a second condition where there's two sub-conditions where you need to meet one of those sub-conditions. So the 50% rule is one of those. The other one is the space that you use in your home has to be exclusively for conducting your employment duties and you regularly meet with clients or customers in that exclusive space. Well, again, our target market, that shouldn't be that hard to say.
Shouldn't be.
Our target audience today, that's not going to be them. So they're going to be out on that condition, so they need to meet the 50% rule. So the question is, how do you measure the 50%?
And this is, go back to the 50% rule, it's 50% of...
Right. So the way that it reads is that you have to be conducting your employment duties primarily from the home office space. So primarily is interpreted as being more than 50%.
More than 50%.
Right.
Gotcha.
But then the question is, in 2020, how do you measure that? Because for a lot of people, like just consider our own staff here. They were working in the office diligently for the first, 2.5 months. And then March, whatever, like literally overnight, they're deployed to work at home 100% for the next many, many months. And then sometime later in the year, it's kind of a hybrid where there's some days in the office, some days still at home. So when you're trying to measure that 50% threshold, is it kind of like the overall average throughout the year, like based on the number of days? Or is it looking at specific periods of time where it could be for the first 2 months, I was 0%, therefore I can't deduct any expenses. For the next, say, 7 months, I was 100%, clearly over 50%, so now I do qualify. And now in the fall, geez, I need to really track my number of days in and out of the office because I might not qualify for any more. And I've read different articles online from some of the experts. Nobody has a clear answer to this. So hopefully, like we're recording this in early November of 2020, so hopefully by the time tax time rolls around in a few months, there's a little bit more clear guidance from the CRA recognizing this will be a very important question that a lot of people are asking.
Yeah, and it may have to do with, well, let's see where the year ends. Mm-hmm. Because if, that vaccine you're working on, you get it deployed tomorrow, then maybe we're all back to work on December 1st kind of a thing. But more than likely, what we're seeing in November is what we'll be seeing in December.
It seems like a reasonable assumption.
That's my guess at this point. So what I want to do is throw out a bunch of expenses.
Right.
And you tell me, do I get to deduct them or not?
I'm laughing because you think this part would be black and white.
Right.
And sometimes it is, sometimes it isn't.
And the answer is no, it isn't. And I think that's kind of the message. If you only remember one thing from what we're talking about today, we don't know what the specific answers are. There has been no specific guidance from CRA. We mentioned all the different, the T2200, the T77, 77747, and the
7 sevens. No.
T and 3 sevens, and then the T40044 guide. But these are all guides and documents that existed in 2019 and 18 and 17.
So there's no update for the unique situation of this year.
For what's going on.
Yeah.
So we are, again, purely speculating. So, okay, I have to buy a mask. So, of course, we have our masks that we carry with us. We've got, of course, the Hoyes Michaelis branded ones. And so our rule is if I'm not sitting at my desk or behind some kind of protective screen, then we're wearing a mask. So do I get to deduct my mask?
Right. And you're talking about the employee.
The employee.
The employee. So, and I guess if you read through the guide, the 4044, it does provide a lot of specific examples of expenses and says yes or no on a bunch of things. But of course, there's no
Nothing
comment
about a mask.
right?
Yeah.
So the best case scenario that it would fall potentially into this catch-all about saying, something that is reasonable in the circumstances. And you find that throughout, interpretations of tax legislation in a lot of different ways. It has to be reasonable in the circumstances.
Yeah, and if I'm working from home,
right? I think you're getting at what I was going to say, right? So again, like our target audience here today, the person who always used to work in the office, who is now working at, the kitchen table or the dining room table or in the bedroom, well, they're not likely meeting with people in person. So in the course of doing their employment duties, they're probably not needing to wear a mask. So, I mean, maybe there's the potential for a situation where it would be required, but I think for the vast majority of people, that would be an expense that just wouldn't fit the kind of catch-all reasonable in the circumstances.
right, doesn't sound like it.
I don't think so.
So, okay, I got deployed to my home and I had to buy a desk to put my computer on.
Right. And again, you would think, intuitively, that sounds...
Because I'm only using it for work. I didn't have it before.
Right. But the answer, black and white, is no, you cannot deduct that desk. And it's coming back, I think, to the comment I made early in the conversation about how the employee in general is not expected to incur capital expenses in the course of doing his or her employment duties.
So if my employer says, look, I'll buy you a desk, put it in your house,
right,
that's fine. There's no tax implication for me as the employee.
That's what I was going to say. I mean, it's tough because it's been such a challenging year for everybody in lots of different ways, financially, emotionally, whatever, like businesses, individuals, like everything. So I do know that a lot of businesses have offered to provide like a small allowance, like you're referring to for people to outfit their home office. But some companies probably can't afford that.
Yeah.
But that would be, I mean, if it is, it would be a nice gesture for companies to do that, just to help people to help share that burden, because they won't be able to legitimately deduct that kind of expense.
And so what about supplies? I need pens and paper at home and staples, and I got a printer at home because I have to occasionally print stuff out to review it or whatever. What about supplies? Can I deduct those?
Right, and that would be something that would be totally legitimate, is very clearly like a black and white yes, as long as you're not reimbursed for it. I mean, I raid the supply cabinet when I come in here, right? So
there's no paper in the office right now because Ian's been here today. Yes. So yes, if you're reimbursed for something, then obviously you don't get to deduct it. If I go to the paper store and buy some paper, and my boss says, here you go, here's the money for it, well, then it's an in and an out.
But that would go back to also that T2200 form that we referred to. Like that's one of the categories where it says, that the employee is required to provide supplies and is or is not reimbursed, right? So it's very
clear, very clear. Okay, those are all minor numbers. What about my rent? Because I'm working from home, why don't I get to deduct my rent?
Yeah, I mean, that's an interesting one where the answer is yes, but in general, only a very small portion. And this would be like rent, utilities, potentially maintenance as well. So historically, like what I'm going to say here is nothing new, but we need to modify it a little bit for the 2020 situation. So historically, if there's like a space that is kind of like a shared use space, like it's partly business, partly personal, the idea is to first come up with a reasonable estimate about what portion is being used in the course of using the business. But we'll use that same idea to say used for employment purposes. So, for example, if you determine that the setup that you have with your desk in the kitchen or wherever is roughly 10% of the square footage, the first cut at is to say, well, 10% of my rent, for example, would be deductible. However, again, given the unique situation where a lot of people who were very quickly deployed back in March, a lot of people just didn't have the setup to have like an exclusive office at home that is clearly 100% for employment duties. So you have people setting up in random spots.
My kitchen table.
Right, throughout their apartment or throughout their house. So technically what you're supposed to do is to first say, well, what's the square footage that I use? But then also come up with an estimate about what portion of time you use that for employment. So, I work there 8 hours a day, but then if it's in my kitchen, obviously I use my kitchen for a good chunk of the time. So it's like you're saying, well, it's 10% of the space, but now I'm estimating that 40% of my time is for employment. So I can deduct 40% and 10%, which would be 4%.
Yeah, and we're getting to numbers that are pretty low, and I want to get into the concept of materiality in a minute. So what about if I have a mortgage, well, it's really the same concept then. Obviously I can't deduct the principal payments on my mortgage under any circumstances because I'm just paying back the house I own. But if I have interest on my mortgage, the thought process would be the same. It's a percentage.
Well,
and
it's interesting is I thought that as well, but preparing for the show, I read through the
show
stuff.
prep.
Yeah, exactly. We do actually prepare sometimes, not all the time.
Not me.
Yeah. So I read through the guide for the first time in a few years, admittedly, and so we talked earlier about the different classifications of employees. So like somebody's earning commission can deduct a portion of his or her mortgage interest, but again, the kind of employee that we're focused on here today, it's a black and white no.
Black and white no. So there you go. What if I had to beef up my internet connection at home because I'm now logging into the office?
Out of luck.
Out of luck, people. Yeah. So there you go. Okay, so you've given pretty clear answers here to a confusing subject. Let's talk about the concept of materiality, which of course is near and dear. You and I are both
accountants.
We were chartered accountants. Now we're called CPAs because we're old. What is materiality?
Right. And to put it very simply, it means that big numbers matter, little numbers don't.
There you go. So what you just described is even if I did actually qualify under some of these things, which it looks like in most cases I don't, the numbers might end up being very small.
Right. Well, I'm thinking that there's people who, and I don't mean this in like a negative way, but there's sometimes people have a kind of a misconception of the tax benefits of write-offs. They see like a movie or a TV show where they think that some guy like, let's say Mr. Trump in the States, right? They have all these write-offs. They just do it for the write-offs, but they don't really understand the mechanics about how it works. So let's assume that somebody goes through all these rules that we've referred to. They consult with their tax preparer in the spring, and they come up with, let's say, $2,000 of legitimate deductible expenses. You're not getting $2,000 back. You're getting a portion of that back. So if your tax rate is 20%, you're going to get back 20% of the $2,000 or $400.
Right.
If your tax rate is 30%, you're going to get back 30% of the $2,000 or $600, which, I mean, I don't want to say
nothing.
Right. It's not nothing, right? So I don't want to downplay that, especially given the situation this year, all the chaos, all the turmoil, extra expenses, whatever. So that's not nothing. But at the same time, you have to kind of weigh it out to say, well, is it worth it? Especially when the CRA can come along and audit you, and they might totally disagree with what you and your accountant came up with in the first place.
So let's get to the good stuff then. You mentioned the word audit. So this is the section of the show where it's for our premium subscribers, paid subscribers only.
Do we have paid
subscribers? No, we don't. Okay. No, I'm just making that up. You worked at CRA for how many years?
7 years.
7 years. And then during that time period, the way I tell the story, I rescued you. You probably tell a different story. So you know what it's like there. And then you came and worked here, and you've been here for
almost 12 years, 12 and a half years.
50 years or something like that. And obviously became a licensed insolvency trustee during that process. So CRA has many decisions to make for 2020. The first decision will be, what do we do about people who applied for CERB through both Service Canada and what's the other way, or through CRA directly,
right? Because
they didn't understand how the system worked. They got double
chaos,
paid.
Right? They got overpaid.
Right. Now, we already know what the answer is. CRA has already started sending out letters to people say, hey, we paid you twice. The systems weren't jiving. You got to pay that money back. That's pretty simple. The next issue will be, what about people who got CERB who perhaps didn't qualify? Maybe they were working part-time. They didn't meet the threshold requirements. That'll be another issue. Well, okay, what about the people who may or may not be claiming home office expenses?
Right.
My question to you is, how aggressively should CRA be auditing individuals?
See, I sometimes I really key in on certain words. You said should, right? How aggressive should they be? My common sense answer is that they should not be very aggressive at all. I hope that they display some concept of this materiality that we were just talking about. So if
it's lucky we talked about materiality then.
Is it coincidence?
This is excellent.
Yes. So I hope there's some concept of materiality as they decide who they're going to review. Like I know for me, when I was an auditor, it's all about risk assessment. So if I was looking at two taxpayers, and I only had time to look at one in detail just based on other pressures. So let's say that they both have roughly the same amount of income. Let's say they both have $100,000 of income, and one person deducts $90,000 of expenses so that they're only paying tax on $10,000. And then the other person deducts only $10,000 so that they're paying tax on $90,000. Well, you tell me, Doug, which one should I spend my time on?
Yeah, I'd be going after the big fish, I think.
Right, and the big fish being the guy who was potentially aggressive, the guy who deducted $90,000 so that he's potentially minimizing his taxes. There's much more potential or risk that built into those deductions. There's things that don't quite fit the rules or are blatant, lies. Right?
Yeah, and it makes sense to me that one of CRA's jobs is to collect money.
Oh, right.
And perhaps that's their primary job. So would it not make sense then?
It's enforcement, right? And
enforcement, yeah.
The concept of the institution, I think, is important and valuable, right? You have an organization separate from Parliament that is intended to enforce the tax legislation so that we all pay our theoretical fair share and it benefits society in whole and we all live happily ever after.
So what you're saying is we should all be in favor of motherhood and apple pie. This is all seems pretty common to me.
Right.
Is it not true that all of CRA's resources go after the big huge corporations because there's millions of dollars there?
This is where you're setting me up a little bit.
I am setting you up here.
Right. So this is what I saw. So I think the concept is good, but it's the practical part that falls apart. So what I saw in my experience, the reason why I'm not optimistic that there will be this kind of common sense materiality kind of approach is that that's not what I saw in 7 years. I saw the vast majority of auditors spend a lot of time, spending way too much time beating up individuals, small business owners for relatively small dollars. And, maybe it's a misunderstanding. Maybe the business owner deducts something that he shouldn't have and he gets a slap on the wrist. But we're talking about small dollars. And, occasionally those auditors do find things that are egregious. So it's not like there's no value to it. But the issue is that you have a much smaller group of people who are supposed to go up against the big boys, right? The big multinational corporations making hundreds of millions, billions of dollars a year. The companies that can afford to have the high-priced lawyers and accountants who are literally paid to find and exploit the gray areas or the loopholes in the tax legislation so that these big companies can minimize the amount of tax that they pay in Canada and around the world. So when you have even the hardest working civil servant who's working 9 to 5, Monday to Friday, when that person or he or she and his colleagues are going up against the large corporation with a team of lawyers getting paid hundreds and hundreds of dollars an hour, who do you guess is going to win that fight most times?
The big guy. I'm pretty sure the big guy.
Exactly. The whole David and Goliath thing, it doesn't happen very often. Yep. Goliath usually wins.
Yep. Yeah, and you're right. If I'm a corporation, a multinational, well, it doesn't have to be multinational, I'm a big corporation, I'm doing a few $100 million in revenue each year, then saving a few million in taxes is a big number. And if I have to pay $500,000 to my tax accountants and lawyers,
it's still a good investment.
And it would be pretty difficult, I would think, for the CRA auditor who doesn't have that kind of resources to be going up against those big guys, because the big guys are going to say, look, here's a section, here's a case law, here's this, here's that.
Exactly. It's so detailed. Like, so even if the auditor comes across something that is a little bit suspicious and they bring it up to the company or the lawyers or the accountants or whatever, they're not going to just roll over, right? They're going to fight this, right? The company paid a lot of money for this whatever tax strategy that they've adopted. They're going to fight this tooth and nail, right? And even if they need to pay some extra money to have their lawyers defend it, it's still going to be a good investment of their time.
And ultimately, if there's a dispute, I guess it can go to tax court or something.
Exactly. These things they take so long, like years and years and years, to wind their way through the tax courts, right? So.
And by that point, well, who's got the deeper pockets and who's going to win?
Yeah, exactly. And so in the meantime, you've got the little guy that is, you use the expression low-hanging fruit. Mm-hmm. So you've got the little guy where the auditor can come along and, find some expenses that maybe aren't legitimate, and they come up with some kind of reassessment, and it costs the individual or the business owner like a little bit of money.
Yeah, and you and I have seen this many times. Hundreds of times. We have people come in to see us. They got a bunch of debt, and some of their debt is tax debt. Mm. And we say to them, what happened? It's like, well, I'm a worker. I'm a plumber. I'm a contractor. I'm a, guy who does work. I'm not an accountant. And so I've got a bookkeeper, and I thought we were doing everything right, but apparently there was some error on how I filed my HST, and I didn't know I was supposed to do the WSIB, and I didn't know what EHT was, and I thought I was doing it, but apparently I'm a monthly filer instead of a quarterly filer, and I thought I was able to.
Well, it's so overwhelming, and somebody in that position, they don't feel that they've had the resources to. Again, we're not talking about having a fancy Toronto Bay Street lawyer. We're just talking about a basic bookkeeper to help you. And some people feel so overwhelmed and so strapped, cash strapped, that they don't pay for the bookkeeper to keep them on top of those things. Where it is, I think, a good investment of resources to help keep you on top if it's not your strong suit.
Yeah, and I don't know what a basic bookkeeper or a basic accountant costs, but over the course of a year, it can be many hundreds of dollars, could be even many thousands of dollars, depending on how many transactions there are. And it's like, well, I'd rather spend the money on buying some more tools or doing a bit more marketing or hiring another employee.
Right. Well, it doesn't seem like a priority until it becomes a priority, until it becomes a real crisis.
Yeah, and the crisis is always 3 years later.
Right. It grows to be such a huge issue that even if you recognize it, the debt that has resulted becomes too much to handle on your own, even if you start doing the right things.
Well, and tell me if this has ever happened to you. Guy comes in to see you and he says, yeah, I haven't filed my taxes for many years.
Yeah, it's happened once or twice, Doug.
Yeah, this week already. Yeah. And it's because, I didn't get the first year done because I was an employee and then I became self-employed and it got really confusing and I just sort of put it aside and now 3 years have gone by and finally they've caught up with me and now I've got a much bigger problem.
Exactly.
So, okay, let's wrap it up then. If you were in charge, you would say, look, do some basic auditing procedures, of course. Like if you got CERB from both EI and CRA, okay, send a letter saying for it back.
Right, that should be black and white.
That's again, low-hanging fruit. And if the rules say you had to make $5,000 or more last year and you didn't, okay, well then I guess the rules say you didn't qualify. So go after the obvious stuff. That kind of makes sense. But you don't want to see them spending all their resources perhaps to collect an extra couple $100.
No, it makes no sense.
But there is no real solution to CRA going after the big, huge corporations because there's no way to win that battle,
right.
is there?
So I guess I feel like that's a separate issue altogether, right? But with how we started today and the idea of home office expenses, there will be some people who again take a bit of an aggressive approach to that and probably deduct things that are not legitimate. Whether they do it on purpose or whether it's a misunderstanding, who knows? But if I was focused on that group of people, I'd be looking for people that are deducting home office expenses for the first time, and it has a significant number. And you can define significant or material in lots of different ways. But I would, not worry about the guy who saved a couple $100 on his taxes.
Yeah, well, and that makes sense. So here's the summary then. Tell me if I got this right. We don't know whether or not CRA will change the home office expense rules for the 2020 tax year.
What do we know, Doug?
We know nothing.
Okay.
We don't know how aggressively they're going to review an audit. So I think my advice, and again, tell me if you agree with this as well, if you're listening to this in November or December or January of 2020 or 2021, save all your receipts.
Right. You want to be careful. You want to be cautious.
Save everything. And then when it comes time to file taxes, then you can decide whether or not something is. So maybe they will come up with a rule that says, oh, you can deduct this if you've got the receipts. Great. So save all your receipts. But it certainly looks like if you were working in the office and now you're working at home because of the pandemic, there is probably very little, maybe nothing that you're going to be able to deduct.
I don't think it's going to be a huge benefit.
And even if it is, the numbers will be very small. So there you go. And again, we're not here to give you personal tax advice. Talk to a tax accountant, talk to a tax lawyer, whatever. Do your own research. And if you're worried about it, err on the side of caution.
That's what I would do.
Because the numbers aren't big enough to get yourself into a huge amount of trouble.
Yep. No, I would agree.
Excellent. Ian, thanks very much for being here.
Oh, always a good time, Doug.
That is our show for today. And I don't know, we'll probably have to do an update in the new year or something as we find out more. But for today, thanks for watching. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.